Every spring, something predictable happens. A deposit lands in millions of bank accounts, and for a brief moment, people feel ahead. $2,000, $3,000, sometimes more. It feels like a reward for being responsible, like proof that the system worked in your favor. You filed correctly, you waited, and now you're being paid back. The narrative is clean. You overpaid your taxes, and now you're receiving your money. There is safety in that story. It reinforces the idea that you are financially competent, that you played by the rules and the outcome validated you. But there is a small technical detail hiding beneath that comfort. A refund is not a bonus. It is not a return on investments. It is not a gain. It is simply excess withholding. It means that from January to December, every paycheck was slightly smaller than it needed to be. Not once, not occasionally, every pay cycle. The system held on to your liquidity for 12 months and returned it without interest. If cash flow is the lifeblood of financial autonomy, then what exactly are we celebrating? Let's quantify it calmly. A $3,600 refund sounds substantial in April. Broken down across the year, it is $300 per month, roughly $75 per week. That is not abstract. That is real liquidity that never entered your control. It did not sit in a high-yield savings account. It did not reduce credit card interest. It did not compound inside an investment portfolio. It did not increase your optionality. It was idle from your perspective. And for professionals in their 30s and 40s who are trying to convert labor into freedom, idle capital is not neutral. It alters trajectory. There is a contradiction embedded in the culture around refunds. Officially, proper withholding is about accuracy. Yet culturally, refunds are marketed as windfalls. What will you do with your refund? The language implies reward. Vacations are planned. Gadgets are purchased. Consumption is framed as celebration. But if that money was yours all along, why does it feel like a prize? Why is it psychologically categorized as extra rather than delayed? The math itself creates tension. No dramatic language is required. A refund is a timing difference, not a performance outcome. This is where the hidden layer begins. The issue is not taxes, it is configuration. It is about how the system shapes behavior through defaults. Withholding tables are designed conservatively. They err on the side of over-collection because under-collection creates political and administrative friction. For the individual, that conservatism feels like safety. You avoid the shock of a tax bill. You eliminate the fear of penalties. You optimize for certainty. But in doing so, you trade precision for comfort, and over time, that trade affects your financial profit margin. Think in business terms. If you run a company and consistently overestimate expenses, you shrink available operating capital. You limit reinvestment, you reduce leverage, you compress optionality. Yet, when it comes to personal finance, many high-income professionals tolerate this compression without analysis. They focus on avoiding a negative surprise rather than maximizing capital deployment efficiency. It feels responsible, but responsibility without optimization can quietly erode long-term compounding. Consider the opportunity cost. If $300 per month were deployed into a simple diversified index fund earning a modest long-term average return, the compounding over a decade is not trivial. Even in a high-yield savings account earning 4 or 5%, that liquidity would at least keep pace with inflation. Instead, it sits at zero return. In an environment where inflation erodes purchasing power by several percent annually, zero is not neutral. It is negative in real terms. The gap between what could have been earned and what was earned becomes invisible because it is never experienced. Invisible losses are the most comfortable kind. Psychologically, this preference makes sense. Loss aversion is powerful. Owing money to the government feels worse than overpaying. A surprise tax bill threatens your psychological baseline. A refund restores it. There is also a forced savings illusion. For people who struggle with discipline, over-withholding feels like automated restraint. It protects against lifestyle creep. It prevents incremental spending. In that sense, the refund becomes a self-imposed discipline mechanism. But discipline achieved through surrendering control is not the same as discipline achieved through design. The deeper issue is autonomy. When you over-withhold, you reduce your own control over the timing of capital deployment. And timing matters. Liquidity is what allows you to respond to opportunities, negotiate from strength, and maintain a higher profit margin in your personal economy. Optionality is built through consistent access to capital, not delayed access. If your goal is long-term financial independence, then control of cash flow is foundational. Structuring your year around delayed access to your own income is a subtle contradiction. From a systems perspective, aggregate over-withholding across millions of workers creates a large pool of temporary float. Governments benefit from predictable cash inflows. Administrative systems prefer excess to shortfall. There is nothing malicious about this. It is structural. But structure shapes outcomes. When default consistently encourage overcollection, behavior adapts around that default. People normalize the refund cycle. They incorporate it into annual spending rituals. They feel wealthy for a weekend rather than incrementally wealthier throughout the year. Here is the psychological shift. You would not voluntarily lend a stranger $3,000 for 12 months at 0% interest. You would expect yield. You would demand terms. Yet through payroll configuration, you do exactly that. Not because you lack intelligence, but because the friction to adjust feels unnecessary. The system seems to be working. But working and optimized are different categories. Many professionals in their 30s feel financially behind despite strong incomes because their systems are safe but not engineered. This is where a stronger framework helps. Think of your financial life as a margin engine. Revenue is your income. Expenses are your lifestyle. The difference is your profit margin. But margin alone is not enough. Margin must be deployed with leverage to compound. Over-withholding reduces available margin throughout the year. It is not catastrophic, but it compresses the engine. A compressed engine produces slower trajectory. Over decades, small compressions widen the gap between looking wealthy and being wealthy. Now, project forward. If you continue over-withholding by $3,000 per year for 20 years, that is $60,000 of cumulative float given up without return. Invested with even moderate compounding, that figure grows meaningfully. The long-term trajectory shifts. On the other hand, if you aggressively under-withhold without planning, you risk penalties and psychological stress. The system punishes imprecision, so most people choose the middle path of comfort. Accept the refund cycle and avoid thinking about it. Institutional incentives reward predictability. Personal autonomy rewards calibration. The structural warning is subtle. In a world where housing is expensive, retirement timelines are extending, and lifestyle creep is normalized through social comparison, small inefficiencies accumulate. The tax refund trap is not about a few $1,000s. It is about identity. Are you someone who optimizes for psychological comfort or for long-term leverage? Do you design your financial systems intentionally, or do you accept defaults because they feel safe? For those who are serious about autonomy, the adjustment is not dramatic. It is deliberate. The goal is not to eliminate refunds entirely. The goal is to quantify them. If your refund is consistently large, recalibrate withholding to approach neutrality. Maintain a small buffer if you value certainty, but choose the buffer size consciously. Redirect incremental monthly cash flow into automated investments or debt reduction. Simulate the discipline of a refund by auto-transferring funds each month into a separate account. The behavior remains disciplined, but the control shifts back to you. The emphasis is not on squeezing every dollar. It is on aligning configuration with long-term compounding. And this is where I want to speak directly to you. If you are between 25 and 45, educated, earning well, and still feeling slightly behind, understand this. It is rarely one dramatic mistake holding you back. It is a series of small structural inefficiencies. Nick Finance exists to surface those inefficiencies calmly and without hype, not to shame you, not to sell urgency, but to sharpen your financial identity. If this perspective resonated, consider what it says about how you view money. Do you see it as something that happens to you once a year, or as a flow you manage continuously? On this channel, we focus on systems thinking, profit margin over appearance, optionality over consumption, long-term trajectory over short-term celebration. The goal is not to look wealthy in April. It is to increase autonomy in your 40s and 50s. Subscribing to Nick Finance is not about daily tips or quick wins. It is about refining how you think, about questioning defaults, about converting labor into freedom through intelligent configuration. Each conversation is designed to make you slightly uncomfortable, then clearer, to validate your intuition that something in the system feels off, and then provide a framework to correct it. You do not need more hustle culture. You need precision. You do not need louder advice. You need sharper mental models. If you are building a life where optionality matters more than optics, where control outweighs consumption, and where compounding is respected as a quiet force, then this is the right environment for you. The next time a refund hits your account, pause. Not to celebrate, not to criticize yourself, just to observe. Ask whether your systems reflect who you intend to become, because wealth is rarely built in dramatic moments. It is engineered in small, consistent adjustments that expand margin and preserve autonomy. If that is the direction you are moving toward, stay with Nick Finance. The conversation here is not urgent. It is long-term, and long-term thinking is what ultimately separates looking financially successful from actually being financially free.